So we're going to talk about a couple of reasons why day traders fail. Now, first time visiting this channel, make sure you hit the like button, hit the subscribe button, because you are bound to learn something interesting today. Reason number one is most traders don't understand the market ecology. Who are the players? Who are the predators? When we look at Wall Street bets or we look at stock twits or any of those social platforms, we have to ask ourselves, who is plotting the information? Who wants me to help pump this penny stock? And furthermore, when did they enter? A lot of retail, they lose money courtesy of these meme frenzies. Of course, we've seen the likes of this happen with meme stocks and crypto. You have to understand that trading is a zero-sum game. It doesn't matter even though your best friend with good intentions says, hey bro, I made some money trading Pepe. You have to still be able to make your own decisions and be your own man and literally trade as a wolf, not as sheep. And that's step number one as to why most day traders fail. And let's talk about reason number two. Most traders do not have a quantifiable strategy. They do not have a strategy at all, actually. And so what ends up happening is you only pay attention to what your P&L is doing. You're not paying attention to what your strategy is doing. Is it helping you win at least 50% of the time? Are you getting a positive R&R or reward risk reward? Are you getting a positive R&R? What that means is for every single unit of risk I take, I seek to make a 50% profit, or a 1.5. That is something that we can quantify through back testing and forward testing, but yet a lot of traders just jump in and they say, well, I feel like this thing's gonna go up without a real strategy. Now, let me point you to something here. We're using what we call Titan AI, found exclusively at Trade 1348. Now, this is our quantifiable strategy, and what we do is we trade the trend. And so here we have our major trend here, our 1348 cloud, and then we have AI signaling a bullish entry of which we enter and find ourselves profitable. We do have AI signaling a move to the downside, of which we reject because it is contrarian to the trend. So what do? We have our band here, which then corrects AI and says, hey, we're going bullish. And of course, this led to market open, and this was a series of profitable trades that were well beyond the 1.5 to 1. Currently, what we have here is our system letting you know where your entry should be and where your stop loss should be. This system is not 100%, but it's over 50%. And as you could see in our trade designs, we guide the trader to the 1.5 to 1 here. You're not just entering a trade and letting it go against you arbitrarily. You are going to be very methodical in setting your stop and preventing yourself from losing money. And that is one of the bigger reasons why traders fail, is they allow themselves to lose more money than they make, because when we're in a winning trade, we sell too fast, and when we're in a losing trade, we hold too long. And this is a human condition. Humans don't like to be wrong. And of course, we could see that with some of the meme stocks out there that, hey, they were wrong for quite some time, and yet they still will not raise their white flag. Having a trading plan. It's very easy to get caught up in the markets and get caught up in a runner and see your P&L just take off. But where do you take profit? And if today is simply an anomaly, how will you perform tomorrow? This is why having a trading plan is mission critical to your success. Each and every day, despite what the market does, you need to do what you need to do. So if your goal is a 1% risk and targeting a 1.5 R, that is a 1.5 return on your port. Now we talk about compounding. Keep in mind, the goal here is to end the day green. It's not to end the day rich. And this is what sets day traders on the wrong path, if you will. It's about compounding. To be successful as a day trader, you need to trade with a plan that lets you sit on the right side of mathematics. And let me show you what this looks like. Let's say you started with a small port, $3,000. You're either trading options or futures or maybe even shares, but you're risking 1%. What does that mean? You're risking $30 per trade. Now, we want to sit on the right side of math. What we're looking for is a 1% on the day, or maybe 1.5. If we target a 1.5 to 1, we are able to compound $3,000 to $146,000. Let me show you what this looks like weekly, because a lot of traders just really get caught up in making the most money on the day. A week's worth of work based on this strategy should make you $184 on your first week. Your second week, $246. Your third, $265. Your fourth, $285. Now, what does that look like on the daily? It doesn't look like much. However, you are on the right side of mathematics. You fall on the wrong side of mathematics when you start overextending your port and you start oversizing, which brings us to reason number 4. How many blown accounts do you have? And how many times when you blew those accounts did you sit back and say, damn, why did I play so big? Then to come back with a new account and do the same thing again. I'm going to show you the mathematics objectively as to what is happening to you and why trading smaller is probably the best thing you could do for your port and for your trading career. So let's go ahead and turn our attention to the risk of ruin calculator. Assuming we have a historical win rate of 40% and an average profit of 1. We really want a 1.5 R, but the reason why I put 1 is because a lot of traders, especially when they find themselves in a hole, they go ahead and take profits way too soon. Now we're risking 5% per trade. So that means if you have a $3,000 account, you're risking $150 per trade. Over 200 trades, you will find that you're 99.4% likely to blow up your account. With a max drawdown of 50%, if you were to change this to 100%, that number becomes less likely. We want to keep our drawdown to 50% because the remaining 50% acts as a buffer and or that reality check. Like, hey, we lost 50% of our account. We now need 100% returns to break even. And that 50% is where a lot of traders start yellowing, which then magnifies the blow up process. Okay, so let's go back to this here. If we were to change a few things, if we were to change our risk per trade to 2% with our average profit loss of 1.5 with only a 40% win rate over 200 trades, our risk of blowing up is only 5.7%, and we would never reach max drawdown. Risk of peak to valley and drawdown 9.7%. So this is proof that risking less will make you more in the long term. Why would it make you more? It makes you more because you're trading for longer. Warren Buffett is one of the wealthiest men on earth, and one of the reasons why he's so wealthy is because he's been able to last in the market for damn near a century. Literally a century. I mean, he's as old as Jesus at this point. Your goal is to trade small to win big. And if anyone would like to have access to this calculator, I'll include a link down in the description. It is called The Risk of Ruin. And guys, you only need to win 40% with a 1.5 target here. Risking 2% and your risk of ruin is very, very small. Now, let's go ahead and do industry standard. Industry standard, 1% risk. Your risk of ruin, 0.05% over 200 trades. Now, we changed this to 5%. And for some, you may think like, well, 5% isn't really that much more. Well, it is. Let's go ahead and change this from 5 to 6%. And as you can see, just every percentage increase magnifies the possibility of you blowing up. So if you want to succeed in this game as a day trader, 1% risk, targeting a 1.5 to 1 reward risk ratio, staying consistent with your trading and not over trading. There was a reason why I put 200 trades there. The reason why I put 200 trades is because a lot of traders will probably go through 200 trades in a week. The goal here is to compound 1% a day. And reason number 5 as to why most day traders fail, we have to look at what your life looks like. If you have a lot of stress in your life, if you have financial obligations in your life, if you feel like your life is falling apart, you should not look to day trading as your ticket. It should not be a last minute solution, scratch off ticket solution to solving your problems. What's happening here is very, very biochemical. When you have a life that's stressful, you're constantly releasing cortisols. Yet when you get into trading, your brain's reward region is going to release the serotonins and the dopamine. And what ends up happening is most beginner day traders start looking to day trading as an escape from the reality of their life, as it's that one opportunity to change their circumstances. But this is what actually happens. The day trader ends up becoming addicted to trading. What you need to do is make sure that your life and your faculties in your life are in order before you jump into trading, because trading is not a solution to your problems. Now, we hear a lot of YouTubers talk about how day trading changed their lives, helped them to make a whole lot of money. And yes, this is true, but I would consider them the outliers. I would consider them the 1%ers. You need to be able to focus on your plan, your risk, and your outcome. And you need to be able to focus on making the faculties or improving the faculties in your life before you enter trading. Otherwise, you're simply going to trade to escape your own reality, and then you end up exhibiting the same type of symptoms as a gambler in the casino. Trade with a plan. You control the markets. Don't let the markets control you. This is Gabe. I'm signing out. Peace.